stock market party. The stock market party. I'll get the into stock market party. I'm rich.
Welcome back to StonkMarketParty. My name is Holden Hope, and I'm here to help you make sense of the numbers, even if I can't make sense of how I'm still living in my parents' basement at 35. Today, we're comparing the pros and cons of these 3 mortgage options so you can make an informed decision, and hopefully not end up where I did. Buying a home is one of the biggest purchases you'll ever make, which is why we're talking mortgages. Simply put, a mortgage is a loan where your home is the collateral. If you don't pay, the lender gets the house. Kind of like when I borrowed my mom's car and forgot to put gas in it, except she doesn't foreclose, she just grounds me. Most people go for 30-year mortgages. They're the classic, like pepperoni pizza. But 15-year mortgages and FHA loans also have their perks, depending on your situation. Let's break it down. Lower interest rates. Banks love 15-year mortgages because they get paid back faster. You save money, and they get peace of mind. Win-win. Faster principal paydown. You build equity faster than I can finish a bag of Doritos during a Netflix binge. Less interest paid overall. For a $300,000 loan at 4%, you'll save tens of thousands in interest compared to a 30-year loan. Cons. Higher monthly payments. The catch? Your payments are like my caffeine habit, intense. For that same $300,000 loan, you're looking at $2,219 a month versus $1,432 for a 30-year mortgage. Lower monthly payments. With 30 years to pay, you can afford a bigger house or just have more room in your budget for avocado toast. Flexibility to invest. The money you save on payments could go into the stock market, crypto, or, if you're me, upgrading your gaming setup. Built-in cushion. Lower payments mean more wiggle room for life surprises, like car repairs, medical bills, or your cat deciding to destroy your couch. Slower principal paydown. It's like watching paint dry. Equity builds, but very slowly. Higher total interest paid over 30 years, you're basically paying for 2 houses but only living in one. FHA loans are the underdog of mortgages. They're backed by the Federal Housing Administration and designed for first-time buyers or those with lower credit scores. Low down payments. Put down as little as 3.5%. Perfect if your savings account looks like mine. Flexible credit requirements. Credit score not great? No problem. FHA loans are forgiving. Mortgage insurance premiums, MIP. The downside? You'll pay MIP upfront and annually. It's like the subscription box you forgot to cancel. FHA loans are like training wheels for first-time buyers. Easier to manage but with added costs. A 15-year mortgage is the speed run version. Fast but demanding. The 30-year mortgage? That's the chill option, letting you take your time. If you qualify for an FHA loan but can handle the payments on a 15-year mortgage, ask yourself, do you want to save more in the long run, or keep it easy now? Here's a pro tip. Get a 30-year mortgage, but pay it like it's a 15-year loan. You'll have the flexibility to adjust when needed and still pay off your home faster. Plus, it's great for avoiding awkward mom, I need to move back in conversations. So, which mortgage is right for you? FHA loans are great for beginners, 15-year mortgages help you save long-term, and 30-year mortgages offer flexibility. Remember, personal finance is personal, like my love for snack breaks between takes. Find what works for you, and make it happen. If this helped, like and subscribe. And check out our indicators for smarter, funnier trading. Thanks for watching, and here's to making moves, even if your first one is out of your parents' basement.